Hey, I'm Richard Matthews. I run a wealth management firm in downtown Greenville and Fountain Inn, South Carolina. I've shot tons of videos on market trends, planning strategies, and financial education, and honestly, at this point, I've just talked too much. I'm bored of the sales pitches I hear in financial media, so now I'm interested in what other local financial experts are thinking about in the upstate South Carolina economy and markets on the No Nonsense Investor. All right, welcome to another episode of No Nonsense Investor. We're here at Floor Field again with the Greenville Drive, and we're super thrilled to be here. They've been amazingly hospitable. We love the location and the people here that are helping us. But we're joined now with Brad Harper. Brad and I also go way back and are going to try to avoid the rabbit holes of our background. But anyway, Brad, tell everybody who you are and why you're here to talk to us.
So I'm Brad Harper. I obviously grew up with Richard. I have a background in finance. I worked a lot of time in the construction vertical, and now I work for corporate America and a Fortune 50 company doing currently analytic strategy and overall strategy for financial services.
Awesome.
Sector.
Very cool. So you are a big corporatist is what I'm hearing, right? Most of our guests are entrepreneurs and small business guys, but you're going to give us the other side of the coin, maybe?
Yeah, I'm trying to infect them with the entrepreneurial disease, but the red tape is quite the vaccine.
Okay.
For
wow.
that. But,
wow, he went there.
But I'm persistent.
Yeah, and we're there, guys. We've gone downhill already, but expect it to continue. It only gets better. We're going to cover real estate. I know that that's not exactly what you do now. However, you've got such a strong background in it. It seems to be a very interesting topic as we move towards the end of 2022, and we see these prices, we see these rates, we see this affordability and income and layoffs, and it's just crazy out there, right?
It is. It's an interesting time. A lot of people like to go back to the 08, 09 market and all of that. I remember sitting on the couch right after we opened a big project and watching the market just to the ground and just thinking like I'm not even a government interventionist, but someone needs to step in and like pause the algorithms here, right? And then, working through the outcomes of that and seeing that unfold. And then now seeing some differences in what the circumstances are and what kind of the acute event that led to then and what it felt like to build up. And there's some similarities too, talking to people that are still in the business, still got our friends a lot in the business, particularly on the production side, which is way more consolidated now than it was back then. They had like maybe, I'm going from memory here, but maybe 50-ish, 60, no more than 60% of the market back then. And I bet they're pushing like 80 or something, but it's a stupid number now.
Isn't that weird?
The publicly held, because their capital's so much cheaper and the banks don't want to loan you money if you're not in the business already at it.
After a crisis, things consolidate. It's kind of odd, isn't it, the way that works out? But cheap money certainly helps things get a little misallocated.
Yeah.
That might be where we find ourselves. But production and supply versus the demand. We've talked a lot about people coming to the state, South Carolina, the upstate, but talk to us a little bit about what you're hearing in the world of production and supply.
So, I think that, real estate is obviously much more localized in the variances, right? So when there's a good market, like historically, we'll take South Carolina, for instance. Before like all the fundamental changes recently, when there was a good market, Charleston always did better. And when there was a bad market, Columbia did better. You had more government money, so you didn't get as much upside, but you didn't get as much downside. So there's localizations within the trends, obviously, but macroeconomically, it's still directional, right?
Yeah, definitely. So with the production issue, we're talking new construction versus the secondary purchase, right? So I've preached a lot about people coming in and displacing with rental units, but specifically just a homeowner purchase, right? If we have had all these years during COVID and the lockdowns and so forth, strained all of our supply chains or whatever we want to say, now that rates are going up and there is a little bit of a back off of demand, is there an oversupply?
I think that there will be, yes. I think the inventory is piling up. I was in the new home space. I think the new home is more of the canary in the coal mine. As we were talking just before we started, if you can buy a new one, you're going to pay more for a new one than a used one. It kind of sets the standard. Their cost is set by what it costs to put it on the market. And, the good builders can predict what they can sell it for and what they can buy it for, and the margin's a good profit. And then the bad ones just build it and put their profit on it. And in good markets, they do well. And in bad markets, they go away.
Yep.
And, that's just kind of how it works. But I think that Yes, I think the inventory is piling up. So I think during COVID, there were like two aspects of the supply chain that I'll talk about that drove up prices from my perspective and what I saw and from my home building background. One, there were like acute shutdowns of this like just-in-time problem, which I'm sure you've probably talked about with a bunch of your guests of, when one factory makes all of one thing, if that factory quits working, like, and no one stores more than, they pride themselves on the train car arrives and then we offload it and 45 minutes later it's in the BMW, right, in the manufacturing line. I mean, that's great as long as the train's running, but if the train stops running, everything stops, right? Yep. It's not like you're going, oh, let me go get one out of the closet.
Just reboot it.
Because there is no closet. You're like, hey, I didn't have to build the closet. Look at me, I'm brilliant.
Nice.
And
no overhead, right?
Yeah, no overhead. So, there's that part. So that caused some like sheer disruptions on things like major things like OSB or something where like you're just going nowhere with you're getting it. And the ones that have to keep moving and have the ability to, they just overpay for it, right? And then the prices go up, and then they're only ones with supply, so they raise the price and the price goes up. So,
there you go.
So there's those acute events. But I also think that the fiscal policy drove a lot of overconsumption.
Sure.
So there was some supply constraints at the same time there was overconsumption. And I think the two of those combined resulted in these massive spikes, right? If you got the Zillow thing, it tells you like 20% year-over-year price increases for 2 years. Like mathematically,
something's wrong with that.
Completely unsustainable. Like you don't have to have a PhD in advanced mathematics to run the numbers here and go, all right, this is going to end by this date, or there's not enough dollars to go around, despite the effort to print them at a miraculous pace.
Yeah. Good deal. So with that, the biggest risk that we've kind of identified here, when we were looking at the overconsumption, right? And it's not even just from a residential purchaser's standpoint, but a lot of these types of purchases, especially around, I'm not going to name specifics, but I do know some home builders that are selling over 50% of their new homes to people looking to rent them out, right? And so we have a lot of private equity coming in. What is the risk of what we may experience, I guess, with private equity?
Yes. So a lot in that question, I think, if you really unpack it. First of all, I think private equity is a huge aspect of it. And one thing we hadn't talked about that I'm going to share a little bit about now that we're thinking about it, that makes a lot of sense to me. So there's the private equity's been throwing money into the single family construction, whereas historically they threw family into multifamily. And you could track those permits different and those markets different. And, they build 500 apartments, they use 500 of the same sink.
Yep.
But they build these other houses, the builders buying them through the same channels as the residential builders always buy them through. And they're buying the same ones that are in their like standard feature set, which is causing a lot more supply chain because they weren't expecting like all of a sudden that like, oh, the Delta Moen 1, 2, 3, 4 is, we're going to need 580 of those when we saw 700 last year, right? And so, there's things like that causing problems. But I think that private equity, is fickle, right? And the returns in the real estate market the last couple of years were astronomical, which means there's probably a lot of deals out there that are baked on unrealistic numbers, which is what happened in '08. There were a lot of deals baked on unrealistic numbers, right? And so, and the anomaly that I hadn't mentioned earlier that we think about it, there was really private equity at play in 2008, 2009. It was caused by, stated income loans, right?
Sure.
So everybody was buying investment homes. Now everybody's putting money in private equity, and private equity is buying investment homes.
Wow.
So in a way, you really just have two bubbles of, private equity investment. It's just like, it just depends on whether you bought your tickets from the Greenville Drive or you bought them on Ticketmaster or StubHub, right? Which we all know that since they gave us a space, definitely buying great from them.
Nice. But with that, we've got the interest rates, right? And so interest rates back then versus now, that's another divider between the two, the Great Recession as well as where we find ourselves today. What are we going to call it? The Great Inflation?
Yeah.
I don't know. That's a new trademark or whatever.
That's a good one.
But we don't necessarily have the capacity that we did back then, right? Or do we? Because we could slam rates back down. We could go back to do a TARP, right? We could do something for what's coming.
Yeah, so I think on that front, right now you're going into what is clearly going to be some headwinds in the housing market, and the Fed has no choice but to push rates up. When they had headwinds because of the financial crisis and the subprime lending thing, like rates were like 5-ish%. I mean, people had loans that they were paying on regularly that they weren't thinking much about that were in the 5 to 7% range.
Except for the ARMs, because the ARMs were the deal. They didn't know 2% were coming.
Right. But the takeaway is there was room to go down.
Right.
Right.
The Fed could do something.
There was room to go down. You could, you could increase buying power. So if someone's in a house and they want a better house, they can buy more house with the same money-ish, right?
Well, it was liquidity, right? That's ultimately what they were doing,
And
because it was locked up.
But at the same time, the one thing that did happen there when they lowered the rates is they dramatically increased the borrowing standards. So even if you did qualify, they just made it really painful to go through the process. But yeah, so I think you have different variables there that it'll be interesting to see how that plays out and what you can do.
So if we keep fighting inflation, if we keep rates going up, maybe at a less steep incline, we'll see in December. But if that's the case, private equity, is there a reason for them to stay? I'm looking for, what is the event?
I don't think there is a reason for them to stay. I think that everyone's used to living, it's kind of like when they print all the money and, everyone was like, oh, the economy's doing great during COVID and like nothing's open and you can't go anywhere and you can't get anything. And everyone's telling you how great the economy is. But you're like, how is the economy getting better by like me sitting on my couch playing PlayStation, right? Like, how is that making more goods and services? And I can't come up with an answer to that. What my theory is
Zoom. We talked.
We did talk a lot.
We did some logistics.
My son's good at that too. So, I've been,
PlayStation
within the child labor laws, the talking. And so, anyways, I think that, the printed money gave the illusion that we were all doing well and these companies were doing well because they haven't, the consequences of the printed money haven't flown through on the expense side, right? So you got the increased revenue, but not the expense. And, you just haven't realized yet that $100 a share just isn't as valuable as it was 18 months earlier.
That's a great point.
Or 2 days earlier.
There was an SNL skit, I think it was in the 70s. Dan Aykroyd was playing Jimmy Carter, and he said the best thing about inflation is soon we'll all be millionaires. That's a great point, right? Let me jump to the challenge question.
Okay.
And this is really putting you on the spot. I'm sure you have no idea how to answer this, but what's causing all this inflation?
Well, I took economics, macroeconomics with Dan Benjamin at Clemson. And in Brackett Hall, if you've ever been to Clemson, you go in, there's a big room, and he believed in education by humiliation to a certain degree. Like if you didn't know the answer and you were kind of dozing off, he was going to call on you and embarrass you in front of like every good-looking girl in the auditorium.
Yeah,
and
a weed-out class.
It was a weed-out class. And, anyways, like there's a few things I remember from that. One of them was like M2 kind of correlates to inflation. And, so when it went up like, 40% or whatever it was.
It's at 39 now, but
right.
Since January 1st.
Then the inflation comes along. I guess you can call it transitory. I don't know. You can call it a lot of things. I mean, but in the South, we always said if it looks like a duck, walks like a duck, and quacks like a duck, it's probably not transitory.
Wow. That was good. I was going to have jokes, but we'll end on that one. That was perfect. Yeah, that's good. Okay, cool. Well, thanks for joining us at the No Nonsense Investor. That was a little nonsensical, but also true. So anyway, thanks, Brad, for being here. Brad is a great friend of mine. I hope to get him on here again because it's a lot of fun. But yeah, here at No Nonsense Investor, what we're trying to do is talk about the local economy, right? And how finance impacts us day in and day out around the upstate of South Carolina. Hopefully you found this informative. If you're interested in real estate, there's plenty to look at that's going on, but definitely want to keep the risks in front of you, the rewards, and think through everything. But join us next time, and we'll see you then.